It's gold is now trading. It's a little bit over 4,000. Let's see, what is it? I'm just looking up as I speak to you. It's 4,050. So it's pulled back from the highs, but this gets into, well, is this a buying opportunity? Well, the big pullback. It is a buying opportunity, but when? And right now, I look at the Hanke Gold Sentiment Score, and the way we get those sentiment scores, Jesse, we text mine the articles that are coming out on gold every hour and determine whether those articles are bullish or bearish.
Gold prices have recently corrected from their highs, stabilizing near $4,050 per ounce. This decline has sparked debate about whether the pullback represents a buying opportunity or a temporary pause in the ongoing rally. Economist Steve Hanke suggests that such corrections are common within a secular bull market and often signal healthy consolidation rather than weakness. He emphasizes that successful timing requires data-driven analysis rather than intuition, as gold's movements are influenced by shifts in market sentiment and investor psychology. Understanding these dynamics helps investors position strategically for the next phase of the market. According to Steve Hanke, investor sentiment plays a decisive role in gold market movements, often pushing prices beyond fundamental values. Periods of deep pessimism usually precede strong recoveries, while excessive optimism can signal nearing peaks. These emotional shifts mirror collective reactions to inflation, uncertainty, and global events. Hanke emphasizes that recognizing these sentiment cycles helps investors distinguish short-term fluctuations from genuine long-term trends in precious metals. Currently, sentiment readings show a slightly bearish tone, but not extreme negativity, suggesting the market remains in a consolidation phase. Hanke interprets this as a waiting period rather than a signal to buy immediately. The best entry point, he argues, comes when sentiment falls to deeply oversold levels, historically followed by strong upward reversals. Until then, Hanke advises patience and careful observation of sentiment trends. His approach, rooted in quantitative, real-time analysis rather than speculation, provides a disciplined framework for navigating gold's cyclical behavior and identifying opportunities grounded in objective market data rather than emotion. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Yeah, well, maybe not quite yet. First of all, let me indicate that actually on September 21st, was the first time publicly I said that I thought the bull secular market, or I should say secular bull market in gold, would peak out at $6,000 an ounce. And it really took off right after that statement. Now, I know correlation does not imply causation, but it did seem to be correlated. So I'll give myself a shout out on that. So I haven't changed my view at all. And a lot of people say, well, how do you come up with that number? And if you look at past bull markets in gold, particularly focusing on the 1980 bull market, it peaked out at around 10%, the price of gold about 10% of disposable personal income in the United States. So that's the back of the envelope kind of calculation. And now you have Goldman and all kinds of other banks coming up with other scenarios and other ways to come up with a peak number, and those seem to be coming in around 5,000, something like that. So the question is, well, now we've had a big correction. I'd say a maxi correction. We're now we're talking. What are we? The 22nd today?
Yeah.
So 22nd of October today, just for the record. And gold is now trading. It's a little bit over 4,000. Let's see, what is it? I'm just looking up as I speak to you. It's 4,050. So it's pulled back from the highs, but this gets into, well, is this a buying opportunity? Well, the big pullback. It is a buying opportunity, but when? And right now, I look at the Hanke Gold Sentiment Score, and the way we get those sentiment scores, Jesse, we text mine the articles that are coming out on gold every hour and determine whether those articles are bullish or bearish, and then develop a score based on those text mining measurements. So it's very high frequency data. It's hourly data. And what you find now, just looking at the readings this morning, Eastern Standard Time, the range goes from -10, that's the most bearish reading. That would be very extreme, which you never get there, but you potentially could get there, or a maximum bullish position +10. And we're getting readings now. The 9 o'clock reading was -26, then 9:30 it was minus about 1.17, and then it went positive. Actually, at 10 it was actually positive 0.326. And then it goes negative again at 10:30, -3.7, and then 11 at minus, not quite as much, 2.1, and 11:30 was the last reading I was obtained. It's about -1. So that's telling you it's consolidating, but kind of in it with a little bit of a bearish tone. It's not reaching an extreme, and an extreme. The buy is when it does reach the extreme on the bearish side. You know that a reversal is coming, and so I would say if we reach -4, -5 in that zone, something like that, I'd certainly want to be buying, because a reversal always occurs at these extreme points. So right now I'd say the market is still consolidating, and with a bearish tone, shall we say. But we'll just wait and see. Keep watching those measurements. That's why the Hanke-Kaufmann Gold Sentiment Score is so important. It's important for high frequency trading and that kind of thing. But positioning and getting into a market, if I conclude that the secular bull is all intact, there's really no problem, and we're going to 6,000, and we've had this huge pullback. Well, the question is, well, when do you buy? How do you optimize your strategy for buying? And you do it with this high frequency Hanke-Kaufmann Gold Sentiment Score. And it looks to me like right now we haven't reached an extreme oversold position and bearishness position, and so I'd just be sitting on the sideline waiting a little bit. I have mining friends that own the mines, literally, that I talk to. But I'm not trading the mining stocks, and they will obviously be following whatever is going on in the bullion market and the expectations about the bullion market. Not only the spot, but also the expectations about where the market's going. But I don't have anything very constructive to say about mining. It's although it's gold, it's really another realm and another, shall we say, skill set to be following all the miners.
On September 21st, Steve Hanke forecasted that gold's secular bull market could reach $6,000 an ounce, a prediction that aligned with a strong market surge. While Hanke acknowledges that correlation does not equal causation, historical precedents, especially the 1980 gold bull run, support this outlook. Simple calculations relating gold prices to US disposable personal income suggest similar peaks, with major institutions like Goldman Sachs projecting levels near $5,000. Gold continues to play a vital role in economic stability, financial reserves, and industrial demand, particularly in electronics and aerospace. Despite a recent pullback, with gold trading around $4,050 on October 22nd, Hanke maintains that the long-term bullish trend remains intact. Although the market has corrected, this consolidation could represent a potential buying opportunity, but careful timing is essential. To refine entry strategies, Steve Hanke highlights the value of his high-frequency Hanke-Kaufmann Gold Sentiment Score. By analyzing hourly gold news to assess bullish or bearish sentiment, the score identifies extreme conditions that often precede reversals. Current readings indicate moderate bearishness without reaching oversold levels, suggesting it may be too early to buy aggressive. While he stays informed on mining operations through industry contacts, Hanke emphasizes that trading mining stocks demands a separate expertise from bullion analysis, underscoring the importance of a disciplined, data-driven approach. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Okay, you summarized a lot of things, and all of them are reasons why gold is in a secular bull market. That's why it's going up. And silver, by the way, you did indicate that I don't pay too much attention to it. It turns out I pay more attention to it than I did when I was talking to you the first time, because one of my old pals from Iowa called me the other day, about 2 weeks ago. I think he called me when it went over $50 an ounce, and said, "Should I liquidate?" And I said, "Liquidate what?" Well, he's got bullion, he's got coins, he's got all kinds of things. No contracts, by the way. It's all physical. And I said, I'll look into it a little bit. I did, and I told him to relax and hang on. So you got silver and gold in the same thing due to all of these things that you rattled off. So that's one thing, trading. Now the other thing about gold is how it would be used in the financial system. That's a different thing than trading or speculating or investing in gold. It's what role gold might play in the international financial system. And one of my mentors, Nobel laureate Robert Mundell, who was, among other things, the father of the euro, so a great guy. Mundell said gold has always played and will always play some role in the international financial system. That was his conclusion. Now, the question is, well, what role? That's what you brought up. And BRICS has talked about gold, and the way to do this would be a currency board arrangement in which you issued a gold-backed currency. That gold-backed currency traded at a fixed rate with gold, and it was backed 100% with gold bullion reserves. That's what they should do. And I've written about this, by the way, numerous articles, including one in the National Review that has actually a draft currency board law for a gold-backed currency. So it's all laid out, very, very straightforward. But BRICS tends to be a little bit more of a talking shop than a doing shop. So we'll see. When I brought this up, by the way, the first time, the article was I was talking about Iran, Turkey, and Russia in the article, and I said what they should do is, in all cases, go to a gold-backed currency. So you'd have a gold-backed lira in Turkey, you'd have the rial in Iran, and gold-backed ruble in Russia, and apparently that was discussed. My moles tell me that a meeting occurred with the Turks, the Iranians, and Russians in Moscow, and it was discussed, and nothing ever happened. Remember that going back historically, that's where the Asian financial crisis began in July of 1997. So, but the currency's been stable. The monetary policy is very, very sound. They're keeping the quantity of money growing in a zone where it should be, and they have. Don't have it at my fingertips right now, but essentially they're hitting their inflation target. They have no inflation problem. They have good monetary management, and that one looks fine. Of course, a bigger one is, I think, India. Is the IPOs are roaring away in India, and even in the face of Trump's tariff threats and everything, I think India is it is still an emerging market. I think, right? It's bad for Americans because the tariffs are nothing more than a sales tax that's imposed on Americans. I mean, when imports come into the customs office, who pays the tariff? Americans do. So that's bad. That's bad for Americans, and overall, it's very bad for international trade. And just the general thing, if international trade is occurring, we have something economists call gains from trade. It's obvious if you're trading something, and the seller and the buyer both have to be benefiting, otherwise there'd be no transaction taking place. And so what you're doing is, with a tariff, you're putting a tax wedge in there and sucking out some of those gains from trade. And what happens at the margin, the marginal players drop out because the tariff sucks all the profit they were making or the gains from trade out of the transaction. And so some of the transactions drop out. And that's exactly what, if you look at the World Economic Outlook from the IMF that came out on the 14th of October, you can see this because they're downgrading the growth estimates going forward. So it's slowing everything down. It's sand in the gears basically, and it's just bad.
In the coming months, gold and silver prices are likely to remain influenced by global monetary trends, geopolitical uncertainty, and shifts in investor sentiment. If inflation pressures persist, while major economies maintain cautious monetary policies, both metals could experience renewed upward momentum as investors seek safety from currency volatility. Silver, with its dual role as a monetary and industrial asset, may outperform gold in periods of economic expansion, driven by rising demand in renewable energy and technology sectors. However, short-term fluctuations are expected as markets adjust to changing interest rate expectations and trade policies. Will the next phase of global economic shifts push these metals to new record highs or bring another round of consolidation first? Should global growth slow or political tensions escalate, safe haven demand will likely strengthen, pushing precious metals higher. Conversely, a stronger dollar or easing inflation could trigger temporary corrections, though the long-term outlook remains favorable for both metals as anchors of financial stability and hedges against economic uncertainty. If you found this information valuable, make sure to hit like and drop a comment below with your thoughts. Don't forget to subscribe and turn on notifications so you never miss the latest updates. Thanks for watching.